And it's very cool.
Oh my gosh.
Isn't that great? Just went up yesterday.
Wow.
Think Joe Biden would do this? I don't think so. Do you think he'd think of it? Do you think he knows what it is?
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks rose for a third day in a row despite sour consumer confidence and as investors weighed whether President Trump would temper his plans for upcoming tariffs. We had a very mixed day across the board, but there definitely were leaders today. We saw the mega caps, stuff like Microsoft, stuff like Apple, stuff like Amazon and Tesla lead today. They were up all in excess of 1% except for Microsoft, which was up 0.5%. In the communications space, Google and Meta was up 1.61 and 1.18% respectively, and we saw the broader communications rally as well. Netflix and Disney also gained. We saw the broader software market put on a show today. They were very green. However, semiconductors didn't do so well. Nvidia fell 0.5 percentage point, AVGO fell 1.5%. We saw semiconductor hardware equipment manufacturers also fell today. They were in the red, along with healthcare and a couple of the other defensive sectors. This breaks down the sector chart more handily. We saw the best performing sector in XLC, discretionary, XLF, financials, all gaining 1.2% and around 0.5 percentage point today. The worst performing sectors were literally just the stock standard defensive sectors. Staples, real estate, financials, and utilities. These were all in the red. So definitely it was a rotation from defensives into growth, into cyclicals, into sensitives, with the S&P 500 gaining 0.23% and gold up 0.43%. And now this is the large cap sectors. We saw small caps take it on the chin. Every single factor segment was actually red here today, but it was only slightly red. It wasn't anything disastrous, down 0.3, 0.5, 0.37% respectively. Mid-cap growth gained just only up 0.06%. We saw the other factors fall, and then large caps, the best performing factor segment, gaining 0.6 and 0.23% respectively in growth and core, and then large cap value falling 0.36% respectively. Globally, we actually had a very positive day. It was green across the globe, except here in China, which is officially in correction territory. Chinese stocks, tech stocks, stuff like Baba, PDD falling 10%, peak to trough. India was pretty red, but we saw a green day in Europe, North America, South America, Southeast Asia, a very green day globally. And most of this enthusiasm comes on the back of Trump's tariffs. Now, Trump did announce secondary tariffs on Venezuela, however, is eyeing a narrower set of reciprocal tariffs. Also, there is news going around that when you look at Venezuela and the oil tariffs that are going to be put on Venezuela and those other countries, it unintentionally benefits Canada. And we're going to see a lot of South American countries probably go to Canada, go to the US to get oil to avoid those 25% tariffs. And also yesterday, Donald Trump said that he may give a lot of countries a break. However, he did say that he will soon announce tariffs on autos, aluminiums, and pharmaceuticals as well. So again, we have this whole push and pull when tariffs on again, tariffs off again, very volatile. That's what we come to expect with a Trump presidency. With regards to economic data, things were very mixed. Consumer confidence came in slightly worse than expected, 92.9 versus 94. But this is a soft data point. When we look at the hard data point, new home sales came in as expected, 0.67 versus 0.68. And then month over month growth was up 1.8% versus negative 7% last month. So the hard data looking very good. The soft data, not that great. It's a very mixed economic data through and through. Tesla was up 3% today. At one point, it was negative, but paired those losses, finishing at the highs of the day. The reason why we saw this move right here had to do with the European Automobile Manufacturers Association. They report Tesla registrations, which is a close proxy for sales in the EU and UK, and that fell 40% in the month of February when the broader EV market saw registrations gain 26%. But it just goes to show how much was priced in already in Tesla, because the stock actually gained 3% on the back of this news. So the market was expecting maybe something much worse than what the ACEA actually reported, and that is why Tesla was up 3% on the day. Boeing was up 1%. They're pushing President Trump's Justice Department to allow it to withdraw a guilty criminal plea agreement it reached with the Biden administration. Now, a door plug flew off an Alaskan Airlines flight made by Boeing. They pleaded guilty to that. They're trying to get out of it. When you have a guilty plea on your record, it can be hard to get government contracts as well as your ability to secure loans. Now, KB Homes, this is very interesting. A home builder in the US actually trimmed its projected 2025 forecast. It fell 5% on the back of this. Now, its previous guidance for revenue was for $7 billion to $7.5 billion. They came out and said, we're very likely going to do $6.6 to $7 billion. Now, it reported very mixed earnings a couple of weeks ago, so lowering the guidance a couple of weeks later. And this is also on the back of Lennar reporting their earnings last week. Very mixed results. And these home builders are having to incentivize a lot to improve housing affordability. Lennar had a 13% incentive rate. Pretty much that means on a $400,000 house, Lennar is having to incentivize $52,000 of that. That is a huge hit to margins, and that is why we're seeing these home builders, their earnings lowered, margins compressing, because they have to incentivize affordability. Hopefully that does change throughout the year, and a lot of these home builder stocks looking very, very attractive for very long-term gains. However, there's still quite a lot of volatility that they need to get through, and that's going to persist for the next 12 to 18 months. But for everything we saw today, we had 2,300 advances, 3,900 decliners. We saw inflows in the New York Stock Exchange, outflows in the NASDAQ 100, the S&P 500 gaining ever so slightly, and market momentum regressed ever so slightly yesterday. However, the 5-day and 20-day moving averages, the shorter term moving averages, continue to be above the 50% territory. And what we really are looking for is a move for these longer term and medium term averages to move into the 50% mark. This is a positive, but the deterioration from yesterday isn't very healthy. Despite the S&P 500 gaining, the average stock actually slipped even lower below their moving averages, and that is not a good thing. When you look at breadth in the broader market, we didn't see things improve as much as they should. But let's hop on the charts. Now, looking at the charts, the S&P 500 and the NASDAQ 100 gained today, and NASDAQ 100 outperforming the broader market. Look at mid caps, small caps falling. The RSP as well falling. So we really just saw outperformance in the large cap names, but looking fairly positive here in the after hours. Growth obviously outperformed value. Volatility continues to behave, as you can see. Near-term volatility slightly less than longer-term front-month volatility. And we actually saw yields fall today. The 2-year, 10-year, 30-year yield, along with the dollar, although it was inconsequential, really. You can see the 2-year yield now at the 4% mark. So yields sort of finding support at the areas where they are right now. The AGG gained, the TLT fell ever so slightly. Bitcoin was up 0.6% today. Gold was also up 0.3%. So a very mixed day. Certainly, I would say a risk-off day, except in the large cap names. And if you look at the S&P 500, we said that yesterday we were at the top end of the range and we were expecting a day of digestion. That's exactly what we got. The gamma flip line did not move up. That probably means we are to expect another day of digestion or potentially a pullback, but nothing crazy in the market. I think we are going to stay above the 5,700 area this week. So if you do get a pullback to this 5,700 area, that's where you want to buy the dip for us to move higher right now. If we do break the 5,700 area, that can be a little bit cause of concern, but I think we're just going to see another day of digestion based on everything I'm seeing. The NASDAQ 100, we said yesterday, it has a little bit of room to run to the upside. That's exactly what it did. It touched the upside right there. A very bullish day, actually. That's a very bullish candle closing at the top end of the range. However, very similar to the S&P 500, the core resistance didn't move up, right? This is called the core wall. It didn't move up. In other words, we probably expect a day of digestion tomorrow, potentially a move lower. But again, the 20,000 level is our line in the sand, and we probably want to buy that level for us to move higher. Looking at the RTY, I only want to be a buyer here at the gamma flip. We couldn't make a move above yesterday's highs like we did in the S&P 500 and the NASDAQ 100. So that is a bit concerning. So wait for the pullback to this 2069 area and then go from there. But equities as a whole looking very, very constructed. It does look like we are forming a bottom, and or the bottom has been formed in stuff like the S&P 500, right? And the NASDAQ 100. If you just go ahead, you can see this is looking like a lower. This is looking like a higher low relative to this, and things looking largely constructive for us to move. We've actually made a pretty big move. And so what we're going to do is just digest some of that move at these highs. Completely normal. It's what you would expect. And digestion can come in the form of us just trading sideways, even pulling back as well. But that's actually going to be very, very healthy for us to move and go ahead and retake some of these highs. But baby steps, as long as we stay above the gamma flip, we will be in an upward sloping trend, at least from these lows right here. We do break below the gamma flip, that's when things can get a little bit crazy. But guys, not much to report on here with regards to equities. You should just really be holding your equities and taking any buying opportunities that we do get if we do get to the gamma flip zone. Don't think we're going to get there this week. I think 5,700 will probably be the closest thing we get in the S&P 500, 20,000 in the NASDAQ 100 and the RTY. We probably get to the gamma flip zone. Now let's actually have a look at gold. Still at a 3,000 level, acting very, very strongly up here. I mean, this looks like looks like it wants to actually go higher. That's what gold is telling us. Now, guys, I think I might actually take a starter position if we get to this level right here and we find support at the 2,900 level. I think I might add to a gold position right here and then add on the way down, because with the way gold is acting right now, I don't ever think we're going to get to 2,700 if you ask me. Looking at Bitcoin looking very similar to equities. We've had a pullback, looking like a bottom has been put in, having a day of digestion after what has been a pretty decent move peak to trough for Bitcoin, up 15%, obviously more volatile than equities. But, these moves need to be digested. As you can see, after we make a big move to the upside, digestion needs to happen. And this is a 15% move from what we saw here in Bitcoin. So that digestion needs to happen. If we go to our trusty indicator, right, our FinFluential global M2 money supply indicator, offset it by 107 days just to see where we are in the pack. Let's go ahead and do that. You can see we are following this indicator exactly line for line. We did break above it a little bit. However, you want to look at the trend, not necessarily the level. So what we are expecting is a pullback to these lows, right? Actually, let me just go draw that in blue. So this is the low. And what we're looking for is a pullback sort of to these lows right here, consolidate, and then we're looking for the next move up. And that next move is going to come in the back end of April, maybe early May, somewhere around there. But expect the initial low to be put in sort of around the mid-April. Very interesting trade. And that's a risk-on signal for the global market as well. So essentially what we are expecting is sort of like consolidation at the lows where we are in the S&P 500, the NASDAQ 100, and then a move higher, potentially retaking all-time highs. Looking at individual names, I do like, guys, I say this every single week, EVVTY, it's a European name. Once we break above this $80 region, we're going to move up 0.63% today. For those of you that are looking at European stocks as well, another name I like is Impost. The chart doesn't look that great. However, when you zoom out for the year, we're seeing a stock standard correction and we're finding support at this critical level where we found support previously right here and springboarded up to all-time highs in Impost. I think this is a very attractive stock. It has a market leading position, and I do think we're going to see the $19 area very, very soon. We're just going to consolidate here for a little bit as the market digests everything that's happening in the world right now. And then in terms of the mega caps, guys, I really do like Nvidia. If you're going to buy any one of the mega caps, buy Meta, buy Nvidia, or buy Google. They're the cheapest, they're growing the most, they have the widest moats, and Nvidia acting very, very well. If you actually look at Nvidia, right, look at this low we put in right here relative to this low, this low, and this low. This is actually a higher low, relatively speaking. And if we go ahead and start retaking some of these highs, right, this would actually signal trend continuation. I like Nvidia here. I think anything below 120 is under fair value. I think about 120, 125 is fair value for Nvidia. And for those of you that are asking, should you buy at fair value of great companies? Yes, generally speaking, buying at fair value, the stock will return in appreciation what it does in earnings, and Nvidia is expected to grow earnings 53% this year. So that might be the return you can expect if we get back to all-time highs. And then some. For the record, Goldman Sachs has a price target of $170. But for all intents and purposes, guys, with the S&P 500, if we do get to the 5,700 area, I'd be a buyer there, looking for higher prices. I'd be a buyer at the gamma flip, but you should already be long from these lows. Just hold. I think we are in for a couple of days of digestion, and then we'll make the next move higher. Stocks don't just go up. We do have days of digestion. It's healthy, and that's exactly what we're seeing right now. So do expect us to continue to do exactly what we did today, maybe even have a couple of red days to end the week. And then we can move higher from there as global M2 money supply comes online. And diving into sentiment, this is the weekly poll that I put up on the weekend. Every single week, I pose a question. And this week I asked, how are you feeling about the S&P 500? 49% of you guys were bullish coming into this week, and rightly so. It's been a pretty bullish week so far. 32% of you were bearish, 19% of you were in the neutral camp. And generally speaking, guys, what sentiment does is create this reinforcing factor. When bullish sentiment leads to higher prices and higher prices lead to bullish sentiment. But the same is true for bearish sentiment as well. So if sentiment turns or if price turns lower, we can definitely see a flip effect, particularly with where valuations are right now and with what the market has done in very recent weeks. Now the S&P 500 has actually been in a correction. You know this factually. That is a peak to trough drawdown of 10% or greater, but under 20%. And generally speaking, when we look at seasonality over the last 5 years, this back end part of March is where seasonals go from a headwind into a tailwind. So regardless for everything we've seen, whether it be the Trump administration, tariffs, or uncertainty, over the last 5 years, we actually have seen a little bit of selling from about the middle of February into the back end of March. And then we actually do see a little bit of a bounce. And we should see very much the same in the S&P 500, assuming seasonality holds true. Now, seasonality isn't a crystal ball, but it does allow us to assess the probabilities. And the probabilities in the last 5 years relative to today is that we do probably go higher at the very minimum. And ultimately, what this pullback is telling us is that the market is pricing in a little bit of extra risk. That risk comes from the Trump administration, and we've seen that risk materialize in the earnings picture. If you look at Q1 earnings revisions, right, at the start of the year or December 31st, we were expecting 11.6% in S&P 500 earnings growth. We're now looking at 7.1%. That is a tangible downward revision. We've seen the same in healthcare, information technology, utilities, communication services. Not a single sector has seen an upward revision so far this year. Earning estimates for Q1 have been revised down a lot, but ultimately what that does now is it provides a low bar for beats. And what I'm expecting in this upcoming earnings season, which starts next week, is for companies to likely reduce their Q2 guide, but reaffirm guidance for the full year. And that should essentially put a floor under stocks, particularly those stocks that are in deep correction territory. Stuff like Nvidia still down 20% from its all-time high. And that floor should also be put under stocks which are not tariff sensitive. Anything related to software is not really tariff sensitive. Stuff like utilities as well, or anything that manufactures their products in America. Now, in light of all of this, retail has still been buying. The S&P 500 has fallen. Retail continued to buy the dip regardless of the volatility, because I do think they actually look at these numbers and still say, hey, yes, earnings have come down a lot, but we are still looking at growth overall. And when you look at something like information tech, you're still looking at mid-teens growth. When you look at something like healthcare, you're looking at 35% growth. And that is why retail has bought the dip. Also, we do know that if we don't get a recession, generally speaking, 10% pullbacks normally resolve higher. The market has realized this. Dip buyers have bought the dip, and that's because we probably are not going to get a recession. We got the latest GDP tracking estimates here from BofA, and their Q1 GDP tracking estimate remains unchanged at 1.9%. Their fourth quarter GDP tracking, which is the revision, at 2.3%. That doesn't scream recession. Also, February core retail sales came in higher than expected. It came in at 1%. The expectation was for 0.2%. And while the headline retail sales number was weaker than expected, the retail core control, which adjusts for GDP growth, came in significantly better. And I think this is the more important figure. It's the figure we use for retail sales on this channel quite a lot. Something else, we got great economic data yesterday. S&P Global Services PMI. The consensus was for 50.8. We got 54.3. Just remember, anything above the 50 mark is an expansion on a month-over-month, year-over-year basis. And we beat consensus estimates by a lot. And US economic output moved higher in March. We also got great data last week, particularly with housing data, mortgage applications. We've seen yields come down, and I think the market is starting to feel those easier yields, that lighter cost of capital, and that's making its way into the market, especially right now. Now, looking at earnings for the rest of the week, on Wednesday before the open, we have Dollar Tree, Chewy, Paychex, Cintas Group, a big day of earnings here on Wednesday, probably the biggest day of the week. And then after the close, we have Concentrix, Jeffries, and that's about it. So it's mostly going to be here before the open where we're going to see a lot of the big and outsized moves. And then looking at data for the rest of the week, on Wednesday, durable goods will dominate the space. And that's about it. We also get mortgage rates, but really we're going to be looking at durable goods month over month, year over year. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.